Wonderful. And before we get into really the details and how it's being implemented, I wanted to address the elephant in the room, right? This is not the industry's first rodeo with portable alpha. So I'd love, Rodrigo, if you can give us a bit of a history lesson of how you've seen it change and evolve and sort of why it went out of vogue and then now why it's back.
Yeah, portable alpha has been around. In fact, PIMCO was one of the progenitors of the idea way back in, I think, 1987, where they decided to provide what they called structural alpha portfolios, mutual funds, and separately managed accounts, where they would give you 100% of their bond portfolio, and then they would buy an S&P 500 E-mini contract for another 100%, providing 2-to-1 exposure so that allocators can use that. So it's been around for decades and decades. And in fact, it became quite popular where by the end of 2008, the 50 largest pension plans, 25% of them were using some sort of portable alpha and loving it. And they were using hedge funds. So most of them were using hedge funds that were fairly illiquid and they thought were adding alpha. But sadly, what happened in '08 was liquidity dried up when that equity component went down, and there were margin calls on the derivatives that they needed, and they needed to go to their alpha sources and say, "Hey, give me some of that money back as I need to rebalance. I need to meet those margin calls." They were met with gating in '08, and to add insult to injury, the alpha they thought they had, which was supposed to be non-correlated traditional equity, they were mostly benefiting. If you look at the hedge fund industry, it's highly correlated to the S&P at the end of the day, right? It's not necessarily zero. And so the problem was that when traditional securities went down, a lot of these hedge funds also went down with the market, which is the number one, I think, lesson learned from '08. And so when that happened, it was really not, you didn't want to talk about portable alpha. The fear that you were using leverage in order to get a double whammy in '08 was a big problem. And so people basically forgot about it. And we transitioned to a world of trying to use security selection in order to try to beat the benchmarks again. And a lot of that went towards private equity, private real estate, and so on. So since '08, a few of these institutions have learned the lessons and have been able to implement the portfolios in a much more thoughtful way where, if I could, I'm just going to show a chart here, just to kind of bring the concept home. So what ends up happening is there were 3 areas of risk here that I think the vast majority of people in investing in portable alpha have dealt with, right? So you have your index exposure, whether it's the S&P 500. Instead of buying it with cash, you would buy a derivative exposure for 5% of your cash. Get that excess return, so you have a lot of free cash here to use. You have to use a little bit of that cash just for margin requirements to get exposure to that derivative. Institutions generally leave a little bit more safety buffer in case they need to fund that margin if they get a margin call. And then whatever cash they have left aside from that safety buffer, they will allocate to the alpha source. Now, the 3 points of pain were some of the bank swaps. Instead of using kind of publicly traded futures contracts, some of the bank swaps, there was some counterparty risk there. So that was a big fear where banks may not have been able to provide the exposure that they promised. Alpha was not really alpha. It became quite correlated to the beta. That's another lesson learned. And then hedge funds gated redemption. So anybody doing portable alpha right now largely deals with all of these by most of the time creating multiple counterparties for the derivatives that going straight to the market in the future space. So that's kind of been dealt with. The safety buffer management has become, risk management is going to be top of the risk management tool for portable alpha. You have to have a team or consultants that can help you with that. And then importantly, the alpha source has to be liquid. It has to be fungible. And as risk increases, you should be able to rebalance easily. And so when you deal with those pain points, all of a sudden portable alpha becomes a really important tool in the toolbox. And there's been a handful of institutions that have used it very successfully, Delta Airlines being one of them, that took the risk in 2011 when they were underfunded and almost going bankrupt, using portable alpha. He called it, John Glidden called it his benchmark beating machine. And in 11 years, he's gone from the most underfunded pension to overfunded. using this concept, using liquid assets and using proper risk management consultants. So that's kind of the history. We're back into being able to talk about portable alpha now. I think there's excitement. Valuations are high. Yields are starting to go down again. We're going to have to look for alternatives. And this is one that is really compelling.